Welcome back, everybody. It's good to have you. We've got some interesting stuff to cover today because two things have happened over the last few weeks. Number one, spring has finally arrived in Milwaukee. And number two, ironically, you might say, the housing market is slowing down. So today I want to take a look at what's really happening in the market. As you know, there is a lot of clickbait type content out on the internet talking about the imminent housing market crash now for a couple of years. The reality is not quite as spectacular. So today we're going to take a look at the data to understand what is really happening. And in the second half of the video, I want to go over some of the commonly cited reasons why the housing market is supposed to crash. We're going to take a look at that. But before we get there, let's take a quick look at the latest numbers from the MLS. April was a very hot market, and you can see this in the numbers. Inventory is up a little bit, just like expected, 2,600 units, up 11.6%. That is still very, very low compared to a benchmark year from 2015. Homes sold down a little bit, minus 8.7%, still in the ballpark, but I attribute that to two factors. Number one, interest rates are really impacting first-time homebuyers. And number two, we see this every time this year. Some of the sellers are pushing the envelope just a little bit too much on list price. And that also plays a role into here, and then they're not selling. Days on market up slightly, 7 days now, still very low compared to the 94 days that we had back in the day. And I expect this number to increase. Probably in May, we will be here double digit. Also increase here on the pricing, plus 8.3%, 260,000 now. So if you've owned an average property in Milwaukee for the last 7 years, you should see typically about $100,000 in equity gain. So fiercely competitive market in April. My team actually managed to get 21 properties under contract, buyers and sellers combined. So if you're one of the lucky ones, congratulations to you. It was not an easy month, but that's a fantastic result, and we're really proud of that. In terms of market segments, the hardest hit were no doubt the first-time homebuyers because they're dealing with inflation, higher gas prices, higher grocery prices, leaving less money on the table for housing, and at the same time, they usually have a smaller down payment, so they're really impacted by the higher mortgage rates. But on the other hand, the first-time homebuyers are by far the largest segment, so there's so many of them that if we're losing 15 or 20%, it still makes for a very competitive market. The most competitive market segment, I think, last month was the middle segment, $300,000 to $500,000. We have seen some crazy offers exceeding $100,000 over asking price. So that was by far the most competitive market segment. The luxury segment is actually showing some signs of moderation, and that is usually where it starts to slow down with luxury properties, $700,000, $800,000 and up. The other noteworthy thing that I've heard from multiple clients in that range is they're liquidating stocks and bringing money into the real estate market because real estate is perceived as safer investment at the moment than the stock market is. Let's take a look at what's going on with buyer traffic. We have very accurate numbers here from showing time, very recent too, from May 17th actually. And let me take you back in history to the light blue line. That is the year of 2020. And what you can see here is the first COVID lockdown. And the reason I'm pointing this out is because you see we were shocked for a little while, but then things went back to normal, market recovered, and showing activity resumed. And we're seeing a little bit of the same pattern as interest rates hit 5%. It really slowed down the market, and then activity resumed again, and now we're trying to find our way. In comparison, we are now the slowest of the last 3 years, still relatively in the same grouping, but we're seeing signs of a slowdown here in the market. Let's take a look what's going on with inflation. We have new numbers here from May 11th, 8.2%. So we're catching a little bit of a break here. We're leveling off. But we have seen that pattern before here where we're hovering over 5% for 3 months. So it remains to be seen if we will stay in single-digit territory or if we see inflation in a few months exceed that and go over 10%. So 1 month doesn't make a trend, but I will curiously be watching this because if you notice, this number lines up very well with the increase of real estate prices in Milwaukee, which was 8.3%. And historically speaking, real estate as an asset class has always been a very good hedge against inflation. So real estate has always at least kept up with inflation, if not did a little bit better. So I will be curiously watching what inflation is going to do over the next months in order to see what that might mean for future home prices. In terms of mortgage rates, we're also catching a little bit of a break. You can see in blue the 30-year leveling off here a little bit, 5.25. This is a theoretical rate if you have perfect credit and no debt to income ratio. Practically speaking, applications that I've seen over the last couple of weeks are coming in usually at about 5.5, 5.75. And what I'm seeing, the market is also getting a little bit more used to that new reality after the initial sticker shock of being out of the 3% ranges. And historically speaking, this is still a very good interest rate, but it's just a shock because we've been spoiled over the last years with fantastic low rates. Now, of course, this also affects affordability. So we have the affordability index, which is down now at 135. And just as a reminder, an affordability of 100 means that a median family income can buy a median single family home. So we're still a little bit on the good side with affordability, but it came down significantly, impacted, of course, by higher home prices and higher mortgage rates. So that really brings the affordability down. But we are still doing better at the moment than we have done in the 90s and in the early 2000s in terms of affordability. And here you can see the real impact of the higher mortgage rates. I have an example of a $300,000 loan. So this is principal and interest only. So that does not include property taxes, which are famously high in Milwaukee. By the way, I have made a short video about this. If you want to know about property taxes, most people misunderstand it a little bit. Look it up, you'll find it on my channel. So this is just the impact. And you can see from the absolute low that we had in January 2021 at 2.7% on a 30-year fixed, that was a $1,200 payment. And now we are a little bit over $1,700. So that is an almost $500 change. And that, of course, is quite a bit in affordability that impacts first-time homebuyers, and that generally has the tendency to cool down the market, of course. Mortgage rates are one of the biggest drivers when it comes to the real estate market. And there's currently something very, very interesting developing that I call the lock-in effect. Now, we need some historic context for that. And you have here a chart that basically spans across my lifetime. So I was born a little bit before here. And you can see for most of my life, mortgage rates have been much higher than they currently are. And they have, very important, they've always been trending down. So over the last 10 years, we have enjoyed very favorable rates between 4 and 5%. And of course, then during COVID, we have seen these super low rates around 3% or even below 3%. And then this little blip is what currently everybody's talking about. Now, I don't think that we will see rates this low in my lifetime ever again. Here's the reason why. The Fed is currently working very hard to fight inflation. In order to do that, they've put too much money into the system to keep the economy propped up during COVID. Now they have to take money out of the system. They have to raise interest rates. So they basically have to cool down the economy, which means that we have to go into a recession in order to get things back down to normal. That's a healthy process. But the unpleasant thing about it is that we are most likely going to see interest rates going back up here like they used to be, into the 5, 6, maybe even 7% range. And they are not likely to come down to where they were again. I think the chance that they would ever come down to 3% or below there is very, very low. I think once we get inflation under control, we may see rates again below 5%, maybe 4.5%. That is possible, but not very likely for the near future. So here we come now to the lock-in effect, because a lot of people have refinanced their homes in the last few years. We've seen a huge run on refinancing. We couldn't even get an appraiser in 2021 because everybody was refinancing the home, and they were going from a 6% rate down to a 3% or even a 2.8% rate. And that's where they're locked in now for 30 years. So what will that do if that homeowner is now thinking about putting the house on the market, which means more inventory for our market? They are looking now at a new mortgage that most likely is going to be over 6%. So they are facing a mortgage rate that is twice of what they have locked in. And this is what I call the lock-in effect. So a lot of people that have refinanced, and that is a large percentage of the population, are now facing the decision that they have to give up their very sweet mortgage rate of 3% or less in order to make a home sale happen, bring the house on the market, and then buy a new house with potentially double of that interest rate. So that is going to be very interesting, because that could become a huge factor when it comes to future inventory that we see in the housing market, and that will, of course, then also drive house prices. So we've seen the market is cooling off a little bit. It looks like we're headed towards a recession. A lot of people are talking about, is this a housing bubble? It certainly feels like it when you look at the feeding frenzy that is going on. It feels like this is a bubble that should pop. And there's a lot of content on the internet, a lot of clickbait that is talking about an imminent market crash. And I want to put a few things in front of you that make me feel confident that we're not going to see a crash as they are predicting. What we might see much more likely is that the market is going to cool down, that we are going to stop seeing further appreciation. So markets will somewhat level off. Prices will level off and prices may go sideways. Maybe they go up 2%, 3%, maybe they go down a couple percent. But I think it's extremely unlikely that we're going to see a real estate market crash as we have seen in 2008. And here is why. So first of all, what does a recession actually do to the housing market? And you have here the data from the last 6 recessions. And you can see that in most of the last 6 recessions, prices either went up or went sideways. We've seen a minus 1.9% here in 1991. Other than that, we're always positive, with the one notable exception of 2008. And as you will remember, that was not a recession that caused the housing market to crash. That was a mortgage crash, housing market crash that caused a recession. So chicken egg situation, just the other way around. But an economic recession, from everything that we know historically, is normally not causing a collapse in home prices. Now here's a chart that shows you home prices in the US from World War II until now. And if you follow the chart, you can see there was only one situation. We had many recessions along the way, but there was only one situation where house prices actually went down, and that was caused here by the mortgage crisis in 2008. Every other single time when we had a recession, home prices were even flatlining or even going up. You can see how this developed over the last 70 years now since World War II. So this is the long-term trend. So what would it actually take to create a market crash as we have seen in 2008? One of the reasons that I keep hearing or seeing on the internet is a wave of foreclosures, and that should be coming from the government's forbearance program. And the forbearance program was something that was concerning for those of you who have been following my channel for the last 2 years. You know that I've been tracking the number. We had originally almost 5 million loans in the forbearance program, so that was a significant number. But the program did what it was designed to do. It kept homeowners in the houses, and the number of people enrolled in the program has come down significantly. As of April, we are down to 690,000. And the good thing about it is also that only a very small percentage of those who are remaining do not have a plan in place. Everybody else had either modified the loan or just caught up on their payments. And so we have 17.1% of what's remaining that could potentially lose their house. But there is a big difference to 2008, and that is equity. Because back in 2008, homeowners did not have much equity, so selling their house was not an option. They had to go into foreclosure because the house was not worth as much as they were owing to the bank. Today, we have a much different situation. Most homeowners have a lot of equity. So if you can't make your payments anymore, the easiest thing is you put the house on the market, you sell it, you save your credit, you save your credit history, and you walk away with a paycheck. So that option did not exist back then. I think we will get some inventory out of the forbearance program. That's much needed inventory, but by the time you divide it up by 50 states, it's actually not going to be that much. The other thing is lending standards. So back then we had, you'll remember the term subprime mortgages. So those are loans to people that have a credit score of under 620. Lending standards have been tightened a lot, and there is a lot less of these loans under 620 credit score. So that's a good thing. You can also see it reflected here in the default risk of mortgages. We had very, very risky products out there in the market. The government put a stop to it after 2008, and now we're looking at a completely different risk profile than we had back then. And also when you look at mortgage debt in terms of how big of a challenge is that for a typical American household, we are here at an all-time low of only 3.8%. No wonder we got in trouble here in October 2007. But thanks to super low mortgage rates, this is actually at an all-time low. So very unlikely that households are going to be defaulting. And if so, then only in a relatively small number, because there's always some. All right, let's take a look at foreclosure activity. So this is always funny when somebody calls me and says, I want to buy some foreclosures for investment properties. There are basically no foreclosures anymore. We used to have almost 3 million foreclosures per year, and now we are down to 78,000. So with all that, where is this going to take us in the near future? Let me first say this. We are coming from a market that was very clear and just competitive. And now we are in a situation that is very complicated, and we're getting a lot of mixed signals from different segments of the market. So on the one hand, we have market segments in Milwaukee that are extremely competitive. I'm seeing a level of competitiveness that I've not seen in the last 2 years. I'm seeing offers written that are so high over asking price that are dwarfing everything that I've seen in 2021. On the other hand, we're seeing market segments in Milwaukee that clearly have started to slow down. We're seeing longer days on market. We're seeing listings that are not selling on the first weekend. We're even seeing price drops. That is something that we have not seen in the last 2 years. So clearly there is a change in direction. And let's take a quick look what the experts are saying about the home price forecast for 2022. So I have here revised data. So this is brand new. This is already incorporating inflation. This is already incorporating the higher mortgage rates and also the economic outlook that we have with the possible recession on the horizon. And they're still, if you average them out, they're still predicting a 9% home price increase for this year. I think Milwaukee will be somewhat close to that national average. But what is remarkable, they've also revised the forecast for the next 5 years. And while the forecast for this year is still relatively strong, we are expecting to see somewhat of a normalization. So home price increases are coming closer to the historic norms. So an increase of 3% or 4% is somewhat in line with historic averages. Let's take a look at the crystal ball. What can we expect for the next few weeks in the Milwaukee market? First of all, I don't foresee a big change in the overall price level. It is very possible that we already passed peak pricing for this year's spring market, but we're still in the general neighborhood, and I don't see that changing very fast. Real estate markets are generally moving a little bit slower. What I do see is that we are going to see more inventory in the next weeks. That means if you're a buyer, more choices. If you're a seller, you have to make sure you are priced correctly, otherwise you risk being on the sidelines. The entry-level market segment will see fewer offers, so that might mean going from 10 offers to just 5 offers because we're losing first-time home buyers because of affordability issues, higher rates, etc. But that still means it remains a quite competitive market. On the other hand, the luxury market segment is going to continue to soften very likely, and this could create an opportunity if you're selling in the entry-level or mid-level segment where it's still very competitive and you're looking to upgrade into a less competitive market segment. That could work to your advantage. Rates are expected to go up, but now slower compared to what we have seen in the previous weeks. And if you are on the fence about listing your property, this is pretty much your last call for hitting the Milwaukee spring market, because that is traditionally over around mid of June, June 15th, when the school year is over. But of course, every situation is different, and if you're not sure how to play your cards correctly, feel free to reach out to me, send me an email. I love talking strategy, and we'll lay out a plan for you for this year or for next year, how to play best your cards. All right, I think that's all I had for you today. Thank you very much for watching. I'll see you at the next one.